Real estate investing versus money lending. Which one is better for you? Let's get into it right now. What's going on, everybody? My name is Andrew, and today I want to talk to you a little bit about the difference between real estate investing and lending out your money. Some of the pros and cons of each, but we're just going to go over this very high level just so you can understand some of the basics. So let's dive into it. Basically, the first thing I want to start off with is that when you're investing into real estate, you are taking the responsibility of the performance of that product. What I mean by that is that if it does well, you reap the benefits. If it doesn't, you reap those detriments as well. And for the most part, we've seen real estate on an uptrend and people have benefited largely from it. So why would somebody decide to lend money instead of investing into that product itself? And people do this for a variety of different reasons. You can see how people will lend out money on mortgages privately, whether it's first position or second position. And we can also see how people will lend out on cars, people will lend out on TVs, people will lend out on just some of the minor second position equity that is available in a property, just so that whoever is borrowing the money can do whatever it is that they're looking to do. But why would somebody go about that? The truth is that generally why people will lend out money like that is because of peace of mind. It's smaller returns, but also less headache. You don't have to worry about the performance of the product or how things are going. For example, if you're lending on a car, the car is supposed to be insured in full, so your investment is fully protected. And then if you're lending on a property, you're usually lending 75 or 80% loan to value, which means that even if the property drops in value or something happens, you can theoretically foreclose on that property and take it essentially for yourself at 80% of the property value, which really minimizes your overall exposure. But what you're now giving up as a result is the benefits of how that product is probably very likely to perform positively, but it's easier money. I think Warren Buffett was the guy who said that 8% is all you ever need in order to get rich. And a lot of people who are lending out money like this do 6 to 12%, and they focus that brain power on other things. But if you're investing in real estate, it means that you have to be applying that brain power to your business or to your investment so that you can make sure that it is going the way you want it. Now that's a bit of a handful, but basically that is in a nutshell what the difference is. What type of person will choose to invest into real estate versus investing into a person, which is effectively what you're doing when you're lending out some money. You're believing in a person and what it is that they're doing, and you're essentially hoping or banking on that their commitment to pay you is going to be enough for you to have that consistency of what you want. And there's things that people do in order to hedge against the risk, right? And generally speaking, the riskier a person is, the more of a cost it is to them, and you are taking more of an upfront fee in order to be able to take this risk onto somebody, right? So cars, if the person that you're lending to is riskier, they're going to have to pay more upfront or maybe a higher interest rate so that you can make sure that you're getting your initial money upfront, and that over time, if they forfeit on their payments, you're at least still mostly covered. And then same thing on mortgages. If you're a less qualified candidate, you are probably paying higher interest rates on that money. You as the lender, you get to collect that monthly check, and you don't have to worry or think about how anything's going. You just make sure that that check is coming in, and if it doesn't, it goes to the lawyers. It's pretty straightforward. It's very hands-off. So if you're the type of person that wants to be very hands-off and you don't need those aggressive returns or something that's going to require your involvement once in a while, then this might be a very good option to you. And I have a few friends who do private mortgages, first and second position, and they do very well. And actually on average, some of them are doing about 18 to 20% returns. The trick here, especially when you're doing this through real estate, so if you're lending on mortgages because it's a very secure asset to lend on, they're doing 18%, 25%, somewhere in there. And that's actually largely because a lot of his client base, they tend to be people who want to get in and out quick, so they're doing projects, so they pay those lender fees, and those lender fees add up. We're talking about 2%, 3% lender fees. So for every $100,000 that you lend out, you're doing like $2,000 to $3,000 as part of the fee. And then if they break the mortgage earlier, that's another 3 months interest. You're looking at another $3,000. We're already at $6,000 just for the in and the out, plus the monthly payments. Let's just call it $1,000 a month. If they hold it for 5 months, you're looking at $11,000 in a 5 to 6 month period of time. That is pretty good money on $100,000. Because if you did it in about 6 months, you can do that twice. So that's $22,000 in a year that you can do lending out money if you do 2 of those mortgages. Some of them might end up dragging along, and they might end up being lent out for a year or 2. And private lenders generally like to turn their money faster, because where they really do well is by taking those penalties and by taking those lender fees. Otherwise, their money just kind of drags on. I've had a few private lenders where our project just took a very long time, and they were really wanting out of the project, asking us to go through a B lender or switch it up because they don't want to continue lending to us, because that is now how they make money. But on the flip side, if you are somebody who wants to be more active, you know, you want to be more involved, thinking about it, looking for deals, assessing things, you want to have a little bit of a say on how your investment performs and reap the benefit in kind, real estate investing will be the way to go. So I am going to leave it at that. But if you understand this few basic things, I think you'll understand the main differences between lending and real estate investing. So if you have any questions, make sure to shoot us a message, email us, text us. We're going to leave our number right here. And remember, like this video, subscribe to our channel. We'll respond to every comment that comes our way, and we'll see you on the next one.